Hey guys, welcome back to another video by Fully Informed Trade, or FiTrade for short, knowledge for everyone. My name is Alex Cho, and today I am just going to analyze the markets and talk about what's going on. First of all, the US dollar index has been moving up on the session and has continued to go higher for the past couple weeks. I believe this uptrend will most likely continue primarily due to the fact that the Euro-US dollar is on a continued downward pace. That being said, let's just draw in a quick chart and talk about the head and shoulder pattern that has emerged on the Euro-US dollar. The neckline, which is approximately right here, has already been broken and pierced into. We've closed right below it on a closing basis for 2 consecutive sessions now. That being said, I believe the Euro-US dollar is on a downtrend primarily due to 2 main factors. One of them being Euro-US dollar is revaluing itself mainly because people in Europe, or primarily the banks in Europe, are seen as slightly unstable, and there's a lot of divestment outside of European bonds and into US Treasury bonds. So that's just one reason, even though the Treasury yields did go up a little bit on the day's session. Another reason that I feel that the Euro-US dollar is on a downtrend has to do with the economic growth. If growth starts to shrink in the Eurozone, it's no surprise to see a lot of divestment outside of European equities and back into US equities, where people feel more confident about growth prospects coming out of US stocks. Also, the falling euro could help to rebalance the trade deficit that's going on in Europe. If that rebalance continues to happen, that means that the exports coming out of Europe become more competitive as imports become less competitive. So the whole idea is there's a double-edged sword going on with the Euro-US dollar pair. On the one hand, exports are more competitive coming out of Europe. On the downside, though, the amount of money European citizens have to spend to buy European products will not really European products, but imported products will most likely go up. Along with that, the import costs of commodities, pure commodities like coal, iron, silver, gold, copper, those raw commodities, even food products, agriculture like corn and stuff like that, will become more expensive as the cost of imports rise. So that can also be a sign of negative, or a negative sign for Europe as well. More competitive exports, but the imports on the commodity side will have a drastic and negative impact on the euro. So we'll see how, or more specifically the Eurozone. So we'll see how it all plays out. Moving on, the Dow Jones Industrial Average has continued its upwards momentum, but a lot of analysts are conclusively saying this is going to be the final move upwards in the market. We have had a minor pullback last week. We've been able to rally up solidly ever since, and now we're wondering if whether or not the markets will eventually start to pull back and give back a lot of those gains. So we've accumulated a lot of bidders in the market for the past couple months. We're not certain of whether or not the markets will eventually pull back, but a lot of people are saying they will, maybe in the next week, maybe in the next couple months. But in the end, a lot of people are expecting some sort of pullback, some sort of give back that's going to be pretty major. But we'll see how it all plays out. My idea, though, is that markets eventually, and every type of pullback, or at least every major pullback, eventually touches the 200-day moving average. So our first target area would have to be the 200-day moving average at around 12,000 Dow Jones Industrial Average. That being said, the economic data is what's primarily supporting the market, even after the dollar index has continued its upwards momentum. Right now, the US dollar index should be trading inverse to the Dow Jones Industrial Averages, but right now that correlation really isn't playing out as well, primarily because of favorable conditions from both the financial system, the stress tests, the favorable results that are most likely going to come out, which are going to be released on Thursday, which is tomorrow, but still everybody is expecting great results from the stress tests, and chances are a lot of financial stocks will be sold anyway once the hype dissipates. That being said, I am not too optimistic on the Thursday session because I anticipate a lot of profit taking from the financial side of the market or the financial stocks. Also, that being said, the US dollar index being in a long-term upwards trend and the Euro-US dollar breaking below that head and shoulder pattern could be seen as a negative sign for US stocks, even with some positive economic news. I still believe there's a correction being baked into this market. Eventually stocks have to pull back. It's a matter of if, not a matter of when. Alright, now let's move on to the next chart when we talk about the E-mini S&P futures on the overnight session. Right now it's 1 a.m. in the morning, Eastern Standard Time, I believe. Markets are starting to pull back a little in the overnight session, and that also implies that the US dollar index is starting out the day a little strong and is bouncing up a little, and that kind of plays into that correlation of the E-mini trading in the opposite direction of the US dollar index. Watch the US dollar index closely and watch the Euro-US dollar closely. I did mention in a blog post that the Euro-US dollar should be able to find some support at around the 1.30110. It did have a subsequent bounce off that level, but at the same time, I only think it's going to be a short-term bounce, and I don't anticipate the Euro-US dollar to find any long-term support considering the pattern we see right in this chart. Alright, now moving on, let's talk about the gold market. Gold market has had a pretty rocky session. It is continuing to get back those gains. A close below the 200-day moving average is not good. I've stated this again, and I've stated this before. Any break below the 200-day moving average, and you're looking at anywhere from around 6 to 10 weeks of continued selling in the gold market. Not good, because again, gold trades on its own set of fundamentals, and people aren't expecting some major radical event to happen, at least not over the next couple weeks. And, you know, with the strong dollar trade continuing to play out, as you guys can go ahead and see, over the past couple weeks now, the US dollar index has continued its upwards trend, whereas the gold market has continued its downwards trend. So the inverse correlation still plays here. And note XAU/US dollar, so this is directly paired to the US dollar, and more importantly the US dollar index. A strengthening movement or a strong upwards move in the US dollar index will inevitably lead to a falling gold market. That being said, how many more weeks? It could be quite a while. Every single time we've seen the 200-day moving average broken, we've seen the gold market struggle for at least 6 to 8 weeks before eventually trading right back and above that 200-day moving average. But the thing that kind of alarms me about the gold market is that it's struggling to stay above that 200-day moving average, and the 200-day moving average is starting to trend lower. Notice this real quick. 200-day moving average is not moving higher, it's trending lower. It's a longer-term average, and if the longer-term average is heading lower and the markets are having an easier time trading below that market, perhaps the fundamentals of the gold market are starting to be questioned, as investors are starting to feel that perhaps gold is not going to generate the yields that they want, and therefore they're selling it and reallocating into safer assets, perhaps stocks and quality stocks, along with higher yielding interest producing bonds, perhaps municipal bonds or corporate treasuries. So we'll see how that plays out. Moving on, silver also seems to be having to deal with the same issues gold is. Again, 200-day moving average is broken quite easily. And the funny thing about the silver market is that it was only able to sustain above that 200-day moving average for a couple days before it too started to close right below it, and it continues to head lower. Again, usually when markets break below the 200-day moving average, and decisively below the 200-day moving average, it usually stays below for anywhere from 6 to 8 weeks, sometimes even longer, maybe 12 to 24 weeks. So we got to be careful on this market, and I can anticipate even more downside for silver to come, at least over the long to short term, as the US dollar index continues to trade on a long-term uptrend. Alright, now let's move on to the next chart, which is the volatility index. The volatility index has had a nice little bounce on the session, although it's unclear why it had such a nice bounce. Moving back to the Dow Jones Industrial Average, we didn't really have a negative session. It was relatively flat, but I think a lot of speculators are buying into the volatility index, perhaps anticipating a major pivot in the market. So let's watch the volatility index very close, as perhaps it could be a leading indicator this time around for perhaps future downside and perhaps a change in broader market sentiment. LifeVantage Group. Now somebody was talking to me about LifeVantage Group, and I had a quick Twitter post about it. But basically, LifeVantage Group has around $39 million in revenue right now. The stock currently trades at approximately $296 million in market capitalization. Now here's the economics behind MLM businesses, and it's also another supplement company. They basically sell vitamins and they market them like Monavie and stuff like that, talking about oxidative stress and anti-aging skincare and stuff like that. There's a lot of MLM companies already in the space that do the same exact thing and sell similar or just similar products. The thing about LifeVantage though is that it's trading at around 10 times its revenues, but the concern I have right now is that its net income is already negative $51 million. I don't know how you lose twice the amount, or just you're just losing more money than what you're bringing in just revenues. Okay, I'm not sure how that's working out. But my bigger concern with this company is that above $100 million in revenues, that's when growth really decelerates in the MLM industry. So once it takes off, it usually struggles at around 100 million, and from 100 million to around $1 billion in sales usually takes anywhere from around 5 to 10 years. And that's the issue, is that people are overbidding the valuation of this stock, and they're pushing the cart ahead of the horse basically. And I anticipate this stock to eventually pull back, just like most stocks do. They always return back to the mean average at around the 20-day moving average, and I have an immediate price target at around $2.20. Hope that helps, guys, and if you have any questions, leave a comment right below.